Welcome back to Daily Crypto. It was a long gap.
It really was.
Yeah, and while we were offline, honestly, so much has happened. Traditional banks have basically been quietly laying the groundwork to swallow like $6 trillion of crypto liquidity.
Oh, easily.
Plus, we had a historic $20 billion wipeout on chain, and early Bitcoiners are literally starting to cash out to buy doomsday bunkers.
Yeah, it's a completely different landscape right now.
It is. We're looking at a market suffering a massive fundamental identity crisis. So our mission today for you listening is to do a deep dive into this massive stack of June 2026 data. We really want to figure out how we ended up with this bizarre split reality.
Right, this weird divide between these sterile institutional power grabs and just total decentralized chaos.
Exactly. But let's start with the raw numbers first, just to set the scene. Bitcoin right now is sitting at $59,756.
Bouncing off that 20-month low.
Yeah, and failing to breach $67,000, which is tough. Ethereum is at $1,572 with gas fees practically non-existent, like 0.07Y.
Which is crazy low.
Insanely low. And Solana is holding around $72. But, I mean, charting these numbers feels almost irrelevant compared to the actual structural forces moving them.
What's fascinating here is that we aren't just looking at regular crypto volatility anymore.
Right.
You know, it's not retail token flips driving this. We are looking at a market reacting to massive real-world macroeconomic and geopolitical earthquakes.
Yeah.
The price action you're seeing on the screen, it's really just a lagging seismograph for global liquidity shifts.
Totally. But hey, before we map out those global shifts, I want to make something crystal clear to you listening.
Oh, definitely, the neutrality thing.
Yes, absolutely. We are about to analyze the market impact of some highly polarizing political figures in international conflicts. Specifically, we're going to mention Donald Trump and the governments of China and Iran.
We have to. It's what the data shows.
Right. But we are looking at this strictly through the lens of market mechanics. We are entirely impartial. We do not endorse any political stance left to right. We're just reporting the facts from our sources to analyze how capital is reacting.
Exactly. We're just mapping the plumbing of global capital. And right now, that plumbing is highly sensitive to trade policy.
Extremely.
Like the most immediate shockwave in the sources was this sudden $875 million crypto market wipeout.
Almost $1 billion just vaporized.
Just gone. And the direct catalyst for that was Donald Trump's proposed tariffs on Europe.
Okay, let's unpack this, because I understand that tariffs create geopolitical tension, but how does a proposed tax on European imports instantly vaporize nearly $1 billion in digital asset value? Like, walk us through that specific liquidity pipe.
Well, it really comes down to algorithmic trading, and risk parity portfolios.
Okay.
So when aggressive tariffs are proposed, these macroeconomic models immediately project a disruption to global supply chains.
Because it's going to cost more to import goods.
Exactly. That signals higher input costs for businesses, which threatens to reignite inflation. And when inflation expectations rise, the U.S. dollar index, the DXY, it typically spikes.
Because the markets assume the Federal Reserve will have to keep interest rates elevated to fight that inflation.
You nailed it. And the moment the DXY spike registers, these institutional trading algorithms, they automatically begin de-risking.
Oh, so humans aren't even making the call.
No, it's instantaneous. They auto-liquidate their highest beta, most speculative assets to free up cash.
To cover potential margin calls in their traditional portfolios, right?
Exactly. And cryptocurrency, despite all the adoption narratives we hear, it is still coded as a high-risk asset in those algorithms. So it gets sold first, automatically and at scale.
Wow. I've used this analogy before that crypto used to be an isolated island, but now it's acting more like a small dinghy tied to the massive cruise ship of traditional finance.
That's a good way to look at it.
But based on what you're saying, it's more literal than that. There are high-pressure liquidity pipes connecting the cruise ship to the dinghy. And wherever the big ship turns, crypto just gets dragged along. When the cruise ship takes on water, like a macro inflation scare, it pumps that water out by draining the liquidity straight from the crypto markets.
That is a much more accurate framework, yeah. And those automated pipes work both ways, which is why the market is currently hyper-fixated on Trump's visit to China.
Oh, right, the China visit.
Institutional traders are treating this as a massive binary event. They're scanning for any rhetorical signal, of either stabilization or escalation.
So if the rhetoric stabilizes, the algorithms might unlock capital, which could fuel a rally for BTC and maybe XRP.
Right. But if tensions escalate, we're going to see another automated drain of the crypto liquidity pool.
Man, that brings us to the situation with Iran, which just adds this incredibly heavy layer of regulatory fear on top of the macro pressure.
Oh, absolutely.
So, TRM Labs recently published a report naming the crypto exchange CoinEx as Iran's largest crypto sanctions exit route. And again, remaining totally neutral here, what's fascinating is the market reaction.
Right, the network data.
Yeah, following that report, there was news of a diplomatic peace deal regarding Iran, and immediately, instantly, Bitcoin network activity erupted. Why the massive spike in block space demand right at that moment?
Because capital was bottlenecked by regulatory terror.
Ah.
That TRM Labs report on CoinEx wasn't just bad PR. It signaled to institutional compliance departments that the U.S. Treasury might initiate a massive crackdown.
Like targeting global routing infrastructure to enforce the sanction.
Exactly. And when that kind of existential threat is hovering, institutional capital just steps back. They don't move. The network activity drops.
So they were basically paralyzed.
Completely. But the moment news of a diplomatic agreement broke, that specific regulatory anxiety vanished. The bottleneck cleared, and all that capital that was parked on the sidelines just flooded back into the mempool all at once.
Wow, causing that huge eruption in activity. Because capital hates a vacuum, and it hates uncertainty even more.
Exactly.
Which seamlessly connects to what's happening on the domestic front right now. Because global volatility is high, domestic politicians are realizing they need to build regulatory fences, right? Like before the 2026 election.
It's creating a mess.
Total mess. The sources show that investment banks are actively warning their clients that these upcoming elections could completely stall major U.S. crypto legislation.
The legislative pipeline is basically freezing up. And for institutional capital, they require legal certainty before deploying billions of dollars.
Naturally.
So a frozen legislative pipeline means they simply cannot allocate.
Wait, wasn't the original ethos of cryptocurrency to be completely immune to political theater and bureaucratic gridlock? Why does a DOJ staffing issue or a Senate bill suddenly have the power to derail the market? I mean, cryptographic math doesn't care about elections.
You're completely right about the math. We have to separate the protocol from the fiat bridges, though.
Okay, the bridges.
Right. The SHA-256 algorithm doesn't care about Congress at all. But the fiduciary duty of a pension fund manager absolutely does.
Right. They can't just throw money into the void.
No, they cannot deploy client capital into a regulatory black hole. The math works, sure, but the fiat off-ramps require legal frameworks. And right now, the optics of that framework are deteriorating rapidly.
They really are, especially if you look at the recent explosive conflict where U.S. senators slammed the Department of Justice.
Oh, that was wild.
Yeah, for shutting down a crypto crime unit, specifically amid allegations of conflicts of interest over personal token holdings. Again, staying neutral on the politicians themselves, but just looking at the market impact when lawmakers accuse the DOJ of making structural enforcement decisions based on their own portfolios, it shatters the illusion of impartial regulation.
Completely. It doesn't look like a controlled rollout of federal guidance. It looks like arbitrary, self-interested chaos.
And as you said earlier, nature abhors a vacuum. Because federal regulation is paralyzed by these conflicts and election delays, state-level authorities are just aggressively stepping in.
Yeah, New York is a prime example.
Right. New York prosecutors are actively pushing to criminalize unlicensed crypto operations, taking this highly localized, punitive approach because there's just no cohesive national standard.
And that is forcing the hand of the major native crypto companies. Like, Coinbase is now threatening to pull its backing for the Senate crypto bill altogether.
Which is a very dangerous game of legislative chicken.
It is, and this institutional panic, it isn't even isolated to the U.S. Over in the UK, the Backbenchers Committee is formally calling for an outright ban on crypto political donations.
Wow, so politicians are basically trying to amputate the industry's ability to lobby.
Exactly. And all of this political gridlock, all this regulatory hostility, it is the exact catalyst for the next major structural shift we're tracking in the deep dive today.
The flight to safety.
Yes. Traditional finance is looking at this fractured, chaotic landscape and realizing it's the perfect environment to execute a hostile takeover of the stablecoin market.
They see the fear in the market, and they're stepping in to sell safety.
Bingo.
So what does this all mean for the architecture of the space? To me, stablecoins have morphed into this massive Trojan horse, but the vector is totally inverted, right? It's not crypto sneaking onto Wall Street to disintermediate the banks. It's traditional banks sneaking into the crypto ecosystem to capture the underlying liquidity.
That is exactly what's happening.
Yeah.
The legacy banks have recognized a fundamental truth here. They cannot compete with the technological efficiency of blockchain settlement.
Right, moving value across borders 204/7 with instant finality is just vastly superior to the traditional SWIFT system.
It's not even close. But, and this is the key, they want absolutely nothing to do with the volatility of Bitcoin. And they flat out refuse to operate on decentralized infrastructure where they don't control the monetary policy.
Obviously. So their solution is to co-opt the technological rails by issuing their own stablecoins.
Exactly. And the scale of this ambition is staggering.
I mean, the CEO of Bank of America is openly warning that up to $6 trillion in traditional deposits could flow straight into stablecoins.
$6 trillion. Because the economic incentive for the banks is just massive. Think about it. If a traditional bank issues a stablecoin, they take your fiat dollars, they give you a digital token that yields 0%.
Right.
And they invest your fiat reserves into treasury bills, currently yielding what, 4 or 5%?
Yeah, I'm there.
They extract all the yield while providing you the quote-unquote privilege of using their blockchain token.
It's the ultimate arbitrage. And they are already laying the concrete for this. I mean, Barclays just made its first stablecoin infrastructure investment by taking a stake in UBIX.
Yep.
They aren't buying Bitcoin. They are buying the plumbing that will settle their own proprietary tokens.
Precisely. And over in Japan, the FBI group just launched JPYSC.
Right, the country's first trust bank-backed yen stablecoin.
And that trust bank element is crucial there because it provides traditional bankruptcy remoteness that algorithmic stablecoins just lack.
Oh, that makes sense. Even the native crypto incumbents are recognizing this shift, right? That the peg to the US dollar might not be enough as the macro environment gets weirder. Tether is now aggressively pivoting toward tokenized gold with the rollout of Scudo for payments.
Yeah, they're trying to offer a digitally native inflation hedge that just bypasses fiat currency entirely.
And building all this institutional architecture requires really pristine, heavily vetted data feeds, which explains why Chainlink is suddenly landing these massive banking deals across Europe and South Korea.
They're integrating directly into the legacy banking tech stacks.
So, okay, here is the contradiction I am struggling to reconcile.
Yeah.
You have Barclays, SBI Group, Bank of America, all fundamentally integrating this technology. Chainlink is securing the data, yet the price of LEN is flat.
Yeah.
And Ethereum gas fees are virtually silent at 0.07 Gwei. So where is the value accrual?
Well, the value accrual is being captured by the banks, not the public blockchains.
Oh.
Yeah. The legacy institutions are utilizing blockchain technology, sure, but they are doing it through private subnets, abstracted layer 2s, or proprietary sidechains.
So they're walling it off.
Exactly. They are extracting the cryptographic utility without requiring the underlying retail liquidity of ETH or Link. They're essentially building private, toll-free express lanes right on top of the public highway.
Here's where it gets really interesting. How do we reconcile these two worlds? On one side, Barclays and Bank of America are building these pristine, hyper-regulated corporate stablecoin networks. And on the other side, the public decentralized frontier is behaving like absolute anarchy.
It really is two distinct realities.
We have Bank of America plotting a $6 trillion takeover, while simultaneously the sources highlight a historic $20 billion on-chain hack and early Bitcoiners literally buying doomsday bunkers.
We're witnessing a severe bifurcation.
Yeah.
The friction between that sanitized institutional layer and the highly experimental decentralized frontier is reaching a breaking point.
Let's look at XRP, because I think its current situation perfectly embodies this schizophrenic market behavior.
Oh, for sure.
XRP is currently hanging by a thread due to the ticking clock of California's DFAL, the Digital Financial Assets Law. For you listening, if you aren't familiar, this law imposes incredibly strict bank-like licensing and reporting requirements on crypto businesses operating in California.
It's a massive, localized existential threat to their operations.
Yeah. And furthermore, the XRP community is fracturing over Ripple's internal 9-year clock regarding their escrow releases. So locally, it's a regulatory and community nightmare.
Yet simultaneously on the global stage, XRP is being positioned as a premier payment routing asset amidst the U.S.-Iran geopolitical tensions we discussed earlier.
Right.
And it is actively being positioned as the technological backbone for a major UK climate bond initiative.
It's so weird. It is a local compliance liability and a global institutional savior at the exact same moment.
It really highlights just how fragmented the legal frameworks are globally.
Absolutely. But nothing highlights the danger of the decentralized frontier quite like the crypto black swan event detailed in the reports.
Okay.
A $20 billion on-chain wipeout. We need to talk about the mechanics of this because 20 billion doesn't just disappear overnight without a massive structural flaw.
No, it doesn't. It was a catastrophic failure of smart contract composability.
Composability, okay.
Yeah. So in the decentralized finance sector, yield protocols are often stacked on top of one another, like digital Legos.
Right, I've seen that.
You deposit asset A to get a receipt token. Then you deposit that receipt token into protocol B to earn more yield. That issues another token, which you then use as collateral in protocol C.
It's just leverage on top of leverage.
Exactly. So when a sophisticated hacker finds a vulnerability in that very first foundational smart contract, it triggers a cascading liquidation across all the dependent protocols.
Wow. And the panic we saw wasn't just from degenerate gamblers, right?
Yeah, not at all. It was from passive income investors who believed they were earning a safe yield. They completely misunderstood the compounded technical risk of interacting purely on-chain, without institutional backstops like FDIC insurance.
It is a brutal lesson in systemic risk. And that macro risk-off environment is even bleeding into the cultural touchstones of crypto. Like Dogecoin is facing a potential massive price collapse directly tied to the macro oil shock.
Yeah, and that is a direct correlation of retail liquidity.
Really? How so?
Well, when crude oil spikes, and everyday consumers are struggling to afford literal gas for their cars.
Right, less disposable income.
Exactly. The disposable income required to pump a high-risk meme token completely evaporates.
Yet human speculative psychology is incredibly stubborn, isn't it? Because the data also shows that a pre-sale for a derivative token called Maxi Doge is nearing $5 million.
Which is wild.
The liquidity didn't disappear, it just migrated further out on the risk curve to chase a cheaper entry point. It's fascinating. And we are seeing strange cultural shifts at the top of the food chain, too.
Oh, the founders and influencers.
Yeah. Vitalik Buterin selling off $1.2 million of ETH at a highly sensitive market moment. Logan Paul auctioning off a $5.3 million Pokemon card. He's completely rotating influencer liquidity out of digital assets and into physical collectibles.
And you have to realize, these aren't just tabloid headlines.
Right.
When founders de-risk and influencers rotate into physical assets, it's a clear indicator that the dominant market participants are acutely aware of the fragility we've been discussing.
Which perfectly explains the most striking detail in the entire stack of sources today. The early Bitcoin adopters, the OGs who mined and bought when this was just a cypherpunk mailing list project, are reportedly converting their massive crypto gains into armored vehicles and reinforced bunkers.
Talk about a shift. That is the ultimate divergence in philosophy right there.
Totally.
The legacy institutions like Barclays and SBI Group, they're adopting blockchain purely as an efficiency upgrade for the existing financial system. But the pioneers who actually built the technology, they still view it primarily as a lifeboat. And they were taking the fiat value they extracted from that lifeboat to build literal physical infrastructure against what they perceive as an impending systemic collapse.
They don't see crypto as a way to fix the banks. They see it as a way to survive the banks.
Exactly.
And man, that brings us to the core synthesis of everything we've unpacked from this June 2026 data. If you step back and look at the geopolitical algorithms draining liquidity, the paralyzed domestic regulators, the aggressive stablecoin takeover by legacy banks, and the sheer chaos of the on-chain ecosystem, you realize the landscape has fundamentally, permanently altered.
The era of the isolated digital island is over.
It really is. Crypto is no longer a closed-loop casino. It is a highly contested battleground, intertwined with global trade wars and massive corporate power grabs.
Moving forward, every major macroeconomic shift is a crypto event. And every major crypto innovation will face an immediate aggressive attempt at institutional capture.
It is a lot to process, but charting this evolving plumbing is exactly why we dive into these sources, so you can stay ahead of the curve. Thanks for listening to Daily Crypto. It's been great. But before we sign off, we want to leave you with one final thought to mull over as you watch these institutional maneuvers unfold. We discussed how legacy banks are building a Trojan horse to capture the $6 trillion stablecoin market. If they actually succeed in taking over the underlying liquidity of the blockchain, does cryptocurrency finally achieve the mass global adoption it always promised? Or does it accidentally recreate the exact centralized permission banking system it was explicitly invented to destroy?